Good afternoon. Good day, everyone. Welcome and thank you for joining. It's great to have you with us. Folks are still coming into the room. It's just after 4:30 Eastern here. Let's start with a quick sound and visual check. Give me a yes and yes in the questions box if you could. Let me know that you can hear me okay and that you can see the screen okay. You should see Eric's screen up there, right there. Thanks, Bob. Rudolph, awesome. Awesome. We're thrilled to have Eric Long with us today. He's with Quant. He's the CEO and managing partner, and he's one of the longtime partners with Top Shelf Traders. Eric is a regular contributor. We also have an ebook that we have access to with Eric, and he is going to be talking with us about using fractals to generate consistent returns. Now, fractals is something that we're asked about on a fairly regular basis. This is something that people have been looking for more content on, the ability to read market patterns, the ability to understand why maybe some of their indicators, some of them spent a lot of money on them, have not necessarily worked. And Eric is going to show us all of that. He's going to talk about what fractal finance is, the reason that chaos theory works naturally within the market, and then how to increase your profits with fractal finance. So, Eric, it's awesome to have you with us again. Thank you for joining. Treat for us. I'll go ahead and turn it over to you, man. Take it away.
Great. Thanks a lot. I appreciate it. First, I just want to say that I thank all of you for being here. And for those of you that may not know who I am or not have seen any of the webinars we've done in the past, my name is Eric Long, and I'm with Quant. And one of the things that we focus on is nonlinear trading indicators, which basically translates to using chaos theory and to work for us. And I just want to preface this by saying that this is somewhat of a spontaneous event because we actually, there's been a project we've been working on the side now for quite some time, and working with some indicators, and we were able to get these to actually function as planned several months ago, and I was pretty excited. I actually sent some screenshots over to Jason, and he said to me, well, hey, do you think we can get an event for this? And I said, well, I don't see why not. So here we are. And let me go ahead and just give you a rundown on what we're going to cover today. There's a lot of material here that we can talk about, but I'm just going to focus basically on what it is that we're using and what we find works. And so we're going to go into a sort of a review of what chaos theory is and why it's good and why it applies to markets and trading. Also cover the fractal itself and what it is. And there's a lot of confusion with this in many different types of forums and discussions, and so I hope to clarify that. And then also we're going to go into a prediction method for using fractals to actually forecast and predict prices. And then last of all, I'll show you some of the indicators that were developed in-house and how you can benefit from using these types of indicators. And we call this indicator set fractal finance, hence the name of the presentation. So on that note, let's go ahead and get started. And first we have the risk disclosure statement to make sure we're all in compliance here. And moving forward, just a quick brief on our company. We're a trading technology firm. We were founded in Chicago, and we've been around since 2007. And we specialize in trading technology, software, and we've built all sorts of different types of tools for ourselves and for clients, and that includes artificial intelligence, neural nets, black boxes, gray boxes. Pretty much we've run the gamut on that. So first, let me just explain to you what it is that we're talking about when we say chaos theory. And again, that doesn't mean that it's something's chaotic and crazy and nuts, but what it does mean is that you're looking at something like, say, a price market. And while you're looking at this, you see prices jumping around all over the place, and you're going, well, I don't see any rhyme or reason to this. It looks like it's just sort of a random mess. And there was a time when economists and many other types of traders, academics, in the field had come to the conclusion that markets are just random. There's really no rhyme or reason to them. It can't be predicted. And since then, that's been disproven. But the thing that makes it difficult to do is that it does appear that there is no order in these chaotic systems, so to speak. What we're going to show you here is that there actually is an order. It's just hidden. So once you can find out how to discover this order, then it makes it a lot easier to predict which way the market's going to go. So just a quick review of some examples. You see it all over the place in nature, whether it's weather, lightning, earthquakes, all sorts of different events that occur in nature. But it also happens in financial markets and all sorts of social natural systems like traffic jams, for instance. And the reason why it's a natural event is because being human beings that make these markets, it starts to form into this natural system that doesn't really operate by what we would call regular statistical types of events. So that plays on why some of the indicators that you may be using are not really designed for this type of forecasting. So leading up to why we use chaos theory and fractals in trading at Quant Trade, as I mentioned earlier, the markets themselves are nonlinear, and the regular conventional technical analysis that you're going to use, are based on just a linear straight line type of math, and it's not really. It's going to give you an average. It's on a, it's based on a bell curve, and that's not really how markets work most of the time. So you're going to find that you're moving in one direction, all of a sudden you get a market reversal, and there's no rhyme or reason for it. Or there's, or by the same token, maybe all of a sudden a trend picks up and you get out early of a trade and you wish you had stayed in. So the reason why a lot of times you miss these types of events is because the tools are not really designed for it. So let's go ahead and give you sort of a conceptual idea of what you're doing when you're using a regular linear type of indicator. So we already mentioned that markets are man-made, they're nonlinear systems. And let's go ahead for a second and visualize an ocean wave. So now if you look at this ocean wave that you see on the screen, you can see that it has all sorts of different curls on it. There's various other waves that are going to look similar to it, but maybe at different scales. And what you're doing when you're using these standard indicators is essentially you're trying to measure the wave with a ruler. So, really, how are you going to take this ruler and measure a wave with it? I mean, you might get some general dimensions to it, but it's not really going to give you a clear idea that it's a wave if you were trying to explain it to somebody. So the answer that we're looking for to be able to do this is the fractal. And the fractal is essentially, it assumes that everything has an infinite scale in nature, and that it's a collection of many similar types of curves, kind of like this this star that you see here. I mean, it has, if you go ahead and there's a formula for this so that it keeps scaling down and it keeps adding on to itself. And even though it looks different, it actually has the same fractal dimension. It's just at different scales. So think of it like a microscope and you're zooming in and out. Now, once you understand what the dimension is of this, you can explain it in a much better fashion. So maybe you're starting to see where I'm going with this as far as the waves and these different types of scales on this star here are very similar to what you might see when you're looking at a trading chart, where you go into one time frame or another time frame or higher time frame. It all really looks similar, but it's different. And if you didn't know what time frame it was and you didn't have anyone telling you or outside information on it, you probably wouldn't know what time frame you're looking at. So that's part of why we want to go ahead and figure out how we can measure the market. So the first person to go ahead and try and do this was a mathematician named Mandelbrot. And what Mandelbrot did is he discovered a new way to measure these irregular objects. So he came across this idea while he was examining the coastline of England, of all places. He wanted to know if there was a way to define this irregular coastline at different scales. So what his solution is the fractal and what's called a fractal dimension. So as it turns out, the coastline of England has a fractal dimension between 1 and 2. If you think about it, if you think of 2 as being a square and 1 as being a line, there's going to be a variation in there that's going to have one specific dimension number. And the thing that's really interesting about that is that that number stays the same approximately across different scales. So if you were to zoom in on the coastline, different parts of it, you still have that same fractal dimension there. Now, this is important because if you're using a linear approach, like most of the standard indicators, what's going to happen is that you're essentially taking a ruler and measuring the coastline of England, and it's never going to work. It's never going to give you one number across different scales, because as you keep shortening that stick, that ruler, you're going to get different lengths of that coastline. So this is why the fractal dimension is really useful for traders, because you can measure that irregularity of the market across scales with just one number. And as a matter of fact, Mandelbrot applied these same techniques to the cotton market to identify and discover that the markets really were not a random walk. And he had argued this for quite a number of years until it really became an accepted concept. So the real way that we want to use this fractal dimension, at least from what I've discovered, is by discovering what's called an attractor. Now, this little object that's spinning around here on this slide, this is an attractor of a certain natural system, okay? And what it is it basically, think of this as if it were a market prices. And what you would have here is you'd have a range of different market prices where there's a maximum and a minimum, and then you would have in between these outer circles sort of random events that were taking place, but they stay within the scope of these larger ranges. So what you want to be able to do is determine what those ranges are as far as prices go, and get at least a general idea of where those random events are going to occur within a range. So the term for it is local randomness and global determinism. So the global determinism is going to be the maximum, minimum price ranges at different scales. And then the randomness is going to be the part that's just random. I mean, there are elements that you're not going to be able to know about. Okay, so going through all of this, and it sounds very interesting and academic, and that's great and nice. But I mean, what's our real goal here? Our goal is to go ahead and take a time series, such as a chart of prices, and then go ahead and plot its future course, right? We want to know what the future holds for our market. So how are we going to do this? Well, there's a lot of people and a lot of different ways to try it or to do it to some degree. Some of the more successful methods are listed here that have been used in a lot of different types of software. And one of them is I have listed at the top, and I've actually worked with it myself, is the ARIMA, which is an auto-regressive moving average. That's what that stands for. And it works better than a standard moving average, but it's still a linear indicator, and it's subject to massive errors when chaos is involved. So I mean, actually, all of these are predictable, are being used to predict the market to some degree, and some work better than others, but they all have certain flaws. So again, the ARIMA works better than a standard moving average, but it's still linear. Neural networks and deep learning are good, and I like them. I've worked with them and built them, but they also have limitations. For instance, they require lots of training data. This also subjects them to curve fitting, and they can also take a long time to calculate depending on what it is you're trying to do. Then there's another one that you run across once in a while, these hidden Markov models. Sometimes they work well. The only problem with these is that they look at immediate price data and they neglect a lot of information in the past that are hidden into the price points that may be weeks, even months prior. So what we started looking at Quant Trade is based on a method that was discovered actually in a strange way. It was discovered by some biologists back in the 90s, a biologist and ecologist named George Sugihara and Robert May. And what they were trying to do is forecast how salmon growth rates were occurring in a certain area. And so basically, during mating seasons, things of that nature. What they started working on is something called lag plots. And a gentleman by the name of Tocken came up with this idea that worked, that tells us that if you can take the lag of a lag plot of a certain set of time series data, and let's think prices here in the market, then you can start to discover those attractors we were talking about, that without knowing what causes them. You don't need to have the formulas that tell you, okay, this is going to go up because this is happening here. So from my standpoint, and I don't know about you, but I don't really care what's causing it as long as we can forecast it and we can use it to trade with and be profitable. So that being said, they started looking at these lag plots and it started working for them. So here at Quant Trade, what we did is we started looking at what they were doing, and we've been examining this for a number of years, and just lately, kind of working on this on the side, we were able to put together an interesting set of indicators that forecast this way. So before we get into that, I just want to show you that you can see here that, remember the attractor that I showed you earlier? Well, think about these lag plots as this graph here. Now what you see there's 3 different plots here. Think of those as price plots. Now there's a lag between each one. It's the exact same data. There's nothing different about it. It's the same prices, but they're just lagged by one and then another one. See where you can see that there on the chart. So this chart on the upper left-hand corner where you can see the movement and the attractor being constructed is showing you that by creating this lag plot, you can actually diagram this attractor. Now, I don't want you to think that there's only 3 dimensions to this attractor. There could be 10, 11, 12 or more, but just to visualize it, we're going to keep it at 3 right now so you can see that. And this is powerful because you can see here that the data from just one set of time series of price can be used out the attractor that makes the whole market system work, at least for that particular market you're looking at. So now all we need to do is just find out how many of those dimensions are really in that market. And as I said, there can be a lot more than 3, so we need to find a way to discover what those are. Okay, so now you can see that we're looking at this. This is not a price chart, but it's a time series. And if you imagine that as being just any standard chart that you look at when you're trading, we're going to go ahead and take this, use a method, a lag plot method, to create our prediction. So we go from that original chart to this attractor. And again, that's going to be different for every single market that we're looking at. But once we discover it, now we have our price ranges and we have a means to make our forecast. Here, what I want to show you is, this is a screenshot of what we created in-house. It's a program that we have that actually used lag plots to map a fractal attractor in IBM. And I just put these in as an example for you so you can visualize it. And right here, we see that there's just a 1 period lag plot. And then I jump ahead here on this next case and go to the 40 period. So now you see that we start to define a fractal attractor inside of this of IBM. So what we're looking at here with the lag plot and how we're going to use it is we need to come up with some points that are near our prediction, and we need to find out how many of these lag points we need in order to go ahead and make sure that we have all of the elements of that system. Because remember, we don't care what they are, we don't care what the variables are, we just want to make sure they're included in our analysis. So, what we're going to do right now is I'm going to go through just a few slides here that show you what we're doing and some of the methods. So, some of this may be new to you and it may look complicated, but don't worry. You don't need to know the details of this technique to use the method. The end result is ultimately what's important, what we're going after. But after I go through a few examples here of how the method works, how it was designed, I'll show you what we built in the multi-charts platform for trading, and then I'll go ahead and show you a trading system that we call Roxy that we're actually trading with using the fractal finance indicators themselves. They're built into the system, and I have some results from today's trading. As a matter of fact, we just exited the market about 5 after 4. So just to explain this real quick here, we've come up with a number of lag plots that we need, and then we also need to find out how many of these nearby points are going to be near our final prediction. So again, without going into a lot of complexity and trying to keep this as simple as possible, we're going to look for essentially an average of the most important points that we find that are coming from those lag plots. So essentially the attractor. Now, what we're going to do in order to find out how many lag plots we need is use the fractal dimension. So every object has a fractal dimension, as I explained earlier with the Island of England example. And because most things in nature are not straight lines, including markets, we can get an accurate read on an object with a fractal dimension. This is also specific to a cloud of points. So now you can make the connection here. If you have a cloud of points, price points, and you're trying to find the lag plots that we're looking for, what we do is we measure the fractal dimension to determine how many dimensions there are in that plot. So that's going to give us what we need to use in order to calculate the prediction as accurately as we can. So maybe think of it as our fractal ruler. Once we know the number, then we can get a fast and accurate prediction. And here's how we do it. So we're going to go ahead and find the amount of lags that we need by measuring the fractal dimension. And as soon as it starts to flatten off, as you might be able to see here, then that means that we hit a point where we have enough lag points to give us the dimensionality of that system, that attractor. And that's all we need at that point. Once we do that, then we just need to find how many of the closest points, nearby points, we want to use in order to average our prediction. So we come up with a formula that's been used that George Sugihara, who I mentioned earlier, used, and he seemed to have success with it. And we put that into the whole trading system or to the prediction system. It doesn't just have to be trading. And then we go ahead and we get our prediction here. So you can see the green line is the prediction. And then what is happening is that we're feeding a prediction back into the system or the predictor to create another prediction. So this keeps going on as far into the future as you want. Again, because there's going to be a degree of error, the further out you go, the more error you're going to have in the forecast. But for trading, what we found here is that if you're using 1 to 3 prediction points ahead, you can have a real advantage in terms of your trading signals. So let's go ahead and make some conclusions about what's going on here with fractals, lag plots, fractal attractors, and chaos theory. So we can go ahead and make a black box nonlinear time series for forecasting. The fractal dimensions give us a very fast automated method to set all the parameters. So what's important about this is we avoid curve fitting, which is always a major obstacle when you're creating trading systems or indicators. And also, being that we can do this with just about any set of time series data, we can automatically build a prediction around anything as long as we have the price data available to us for that market. Again, it's useful with any type of price or time series data, and I've found it is great for building trading systems, especially if you're using some sort of predictive element to that trading system. So what I want to do now is go ahead and take a break from this PowerPoint presentation and show you something that's a little more dynamic. So I'm going to go ahead and switch to, just bear with me please, to a remote server that I have some indicators running on and actually have a trading system on, and I'll show you how the fractal finance indicators have performed and what they're doing. Okay, let's go ahead and I'm going to minimize this. All right, so what you see here in front of you right now is the multi-charts trading software platform. And the blue line that's listed, that's on top of the price chart, is the fractal finance predictor, that is predicting one step ahead. So it's actually predicting the price one step ahead of time. Now, what I also have to show you is that we can take this, you can see that it's very close in terms of the accuracy. And as a matter of fact, we have an indicator that's used for measuring the error of the prediction. I mean, you're always going to have some degree of error, but what I found is that this is very low. And you'll see here on the bottom, okay, it's calculating. If you look at the indicator that appears here in just a few seconds on the bottom of the chart, you'll see what is the error between the prediction and the actual price. So the line in the center there, the 0, is the actual price versus the predicted price. So we're getting a very good accuracy there. Now, if we continue on and take the same predictor and predict it further into the future, it's easy enough to do that. So what I'm going to do now is take this indicator. It's the same fractal finance indicator, but it's set up to predict 2 steps into the future. So it'll calculate here for just a few seconds, and then it'll place a red line on top of the price, which is going to give us our future 2-step prediction. So you can see that there's differences in the way that the prices are between the 2 different predictions, and that's because we're offsetting it by 2 to correspond with the prediction of 2 steps ahead. Now, one of the other things that we did, and we use this inside of our trading system, and we found this to be pretty useful for improving the trade quality, is taking the actual prediction and averaging it, smoothing it. So hold on one second. I'm going to turn off the system that's running here. We can take a look at that again in just a minute. But you can see here that this is the same predictor, the blue line here, and then we just went ahead and turned it into a forward-looking moving average, and it's actually using the predictor and it's averaging that by just 2 points. So what it's doing is it's smoothed it and it's made it even that much more accurate in terms of the price points and price predictions. So what's really neat about this is that we've taken a prediction, we've smoothed it just a little bit, and now we have a moving average that actually looks ahead into the future. It's a predictive moving average. It's not lagging. So now to get to the nuts and bolts, how does this work in a trading system? So let me go ahead and show you. So this is one that we are running today. And you can see that it's a real simple idea. All that it does is that we use a buy and sell method that takes a look at the predicted price and takes a look at the current price. And if it sees that the price is closing below the predicted price, it goes in that direction. So it'll either go short or long. And now we haven't actually, because this is relatively new, we haven't actually traded it this long, but I did run a test for you to see, what kind of net result we're looking at. The way this is set up is that it'll either lose $500 for the day and stop trading, or it'll make $1,000 and stop trading, or anything in between. So this is, what we've had in terms of consistency going back to before we were even running it live, so back to about close to the middle of March. And then also, we were fortunate enough to have a client of ours who is trading the system, and we're controlling it from our side to allow us to show his account. And I'm going to go ahead and show you what that did today on the September contract. We're actually trading we're still using the June contract here, but this was a switch over to the September contract in the S&P 500, mini S&P 500. Let's go ahead and get this. Second, please. Okay, so here we go for today's trading. So today this made 337.50. Same, you can see it's the same type of trading style system. It's actually exactly the same. So what I'm getting at here is that we have a method, and I'm not even saying that this is the best way to trade it, but that's working consistently so far since we've been doing it. And there's really no reason why it should change, because based on the method we're using, we're not curve fitting anything. So it's just the predictor is just taking a look at all of these data points, goes back, uses that fractal dimension to figure out how many of these lag points we need. Then it comes up and takes an average. We're just using a weighted exponential moving average of the number of the nearest points determined by that one formula I showed you near the end of the slides. And then we get a prediction. And then we just feed that prediction back into the prediction to go further out. So really what we're talking about here is it's a simple concept, but it's really, it was very elusive to code it and figure it out. But we're happy to have it now. So I just wanted to share that with you, and I hope you find it as interesting as I do and Jason did. Also, one of the things that we decided to do is make the indicators available to you if you're interested in doing them. If you want to go ahead and build something on your own and you have a concept on how to do that and you're a coder, I'd be more than happy to send you some of the notes that we put together while we were going through this. It's somewhat of an arduous task, but if you're interested in doing that, have a shot at it. I'd love to hear what you come up with. And otherwise, if you want to obtain the actual toolbox that I'm using here that I showed you, you can get that. It's available from a landing page we set up for you that's going to be made available to you at the end of the event today. And also, I know a lot of you may not have multi-charts and you're still interested in using the fractal finance indicators. So I was able to, through a contact of mine at Multi-Charts, I was able to arrange for a discount for anyone that wants to pick up a lifetime license. It's a discount of $150, and that's also available via a link that will be sent to you. And then last of all, if there's something that you want to use as another platform and you're interested in obtaining the Fractal Finance Toolbox, then just contact us. I mean, we can code in just about every platform. This is just the one that I happen to prefer, and I was doing some of the coding with our programmers, so I wanted to be able to interact with it easy. But we can definitely do a translation. Just contact us and we'll let you know how to do that. So at this point, I would say, Jason, that that's really about it as far as the fractal finance is concerned.
That's awesome. That's awesome. We got one question coming in here from Lawrence. Lawrence is asking, does it work MC.net or regular MC? Hopefully that question makes sense to you, Eric.
Yes, it does. This is set up using the power language, like I said, because I'm not really a good programmer. I mean, I know a little C# and C++, but enough to be dangerous. So we did it with the just the standard multi-charts, but it wouldn't be a problem to go ahead and get a translation over to the .net. Like I said, it'd probably take us 3 weeks or less to do it for you.
Great. So the follow-up question to that is, so it should translate to TradeStation, no problem?
Correct. Yeah, we can we can definitely translate it to TradeStation because the easy language and power language is basically the same.
Got it. Got it. Uh, Eric, just as exciting as when we last talked about it. Very, very cool stuff. For those of you that have been following along and that just joined us, coming in at the end of the day, wherever you are, we have a recording of this event that we'll send out. We also thought that the discount, the license discount that Eric was able to get was very, very exciting and also new for us. We haven't had a lot of those opportunities come along, so that's great.
Good. Happy to hear it.
One other question that's coming through is how about NinjaTrader 8? Any idea about the cost to convert to that?
Right. Yeah. As far as the converting to NinjaTrader, that, again, that's not a problem. It'll be about the same translation time. There's as far as the cost goes, we listed the toolkit at $655, I believe, and that's basically just to cover our maintenance costs and dealing with support and that sort of thing. So the only thing that we ask is that if we're doing a translation, because of the time involved, that it's paid in advance and that you can allow 3 weeks before we deliver it. So that's not a problem, though, to answer the question.
Okay, cool. I think that's just about everything. Gary, thank you for your question. Lawrence, thank you for your question. Eric, awesome job. Thank you very much, as always.
Thank you for having me. I appreciate it. Always a pleasure.
Pleasure here as well. We'll go ahead and we'll call it a day. We'll get a recording link out to everyone. We'll also get the relevant links that Eric is sharing here on his current slide, fractalfinance.com, and also his contact information to you as well. And we'll look forward to having you back soon, Eric, in the near future. And for the rest of you out there, thank you for joining us today. We look forward to having you at our next event. Take care.
Thank you, Jason. Take care.
Of course, you too. Bye-bye.